Hi, I'm Linda Eedes. I'm a member of the RECM investment team, and today I'm going to give you an update on the RECM Global Flexible Fund. Now, this fund seeks to grow capital in real terms and protect against permanent capital loss. It's a fund that we've been managing since 2003, and we manage it today in exactly the same way as we've managed the fund throughout time to deliver those objectives to our investors over full market cycles. However, over the last year, if you look at the returns, there have actually been some negative returns, and I can understand that investors are perhaps questioning whether we actually are sticking to our objectives as I named them at the start. Now, the important thing is to remember what we do as value investors and why we do it. So we seek to invest in undervalued assets because those have the best prospect of delivering good outcomes to our investors in real terms. And if you buy assets cheaply, you have some protection against further downside risk. To protect against permanent capital losses, you need to steer away from assets which are trading well above their fundamental worth. Now, this is very interesting because in the last 3 years, at the start of that period, the stocks which were already trading above their fundamental worth have become even more expensive. So it doesn't seem to have been the right philosophy to have actually steered away from those stocks in favor of stocks such as those in the resources sector, for instance, which may have been compelling enough to invest in 3 years ago, but which have continued on that downward trajectory since. So if they were cheap 3 years ago, they're even cheaper today. In the process, of course, you've seen negative returns in the fund. So we sit with a portfolio today, but which very importantly is unrealized in terms of the losses, but where we've had many successes in terms of stocks which have performed well, which are unfortunately masked by those which continue to be cheap, but which include the likes of Sun International, HCI, Grand Parade, Capitec, Lewis, Old Mutual. On the global side, Wells Fargo, Bank of America, Berkshire Hathaway. Many stocks which we've realized gains from, but which, as I say, unfortunately, you don't get the benefit of at this point because we've got these unrealized losses from this part of the market, which has remained cheap and has actually become increasingly so. So where to from here? Well, we sit with a market environment which we know is very inefficient. That is a great time to be an active investor. You want a market environment where there are many mispriced assets. You want to steer away from the stuff that is mispriced on the upside, which is priced too attractively, and you want to invest increasingly in those assets where the market is being overly pessimistic, where the market is extrapolating the negative news and saying they will never recover, and where the upside is immense. Now, globally and locally, we do see that that is increasingly in the cyclical part of the market and less so in sort of the high quality businesses, less so in the industrials, more so in areas such as resources, and one could argue in retail as well, particularly on the global side. So the portfolio is positioned to take advantage of a market environment which is one of the types of market environments which actually creates the opportunities for value investment as a philosophy to triumph over time. So where there's so much uncertainty, where there's volatility, where the market doesn't know if things should be up or down, and you can see that in terms of the magnitude of moves from one day to the next, that is precisely the type of environment where you want a portfolio such as the RECM Global Flexible Fund, which is invested away from the risk of permanent capital loss, the overpriced assets in the market, and towards those parts of the market which are trading at, in many cases, all-time low valuations. So let's talk a bit about mining, because that is obviously part of the reason for the underperformance. It's also the most compelling area of the market today. And there we're talking specifically about areas like platinum and not so much about areas like iron ore. The last time mining was cheap in the context of an overall market environment that was expensive was prior to the bursting of the dot-com bubble. Now, if you cast your minds back, that was sort of 99, 2000. It was all about the new world, stocks and companies, and the old world, things like mining were very much out of favor. Mining was cheap then, and when the market declined from peak to trough, when the market fell by 49%, when those prices for all those, in particular the technology businesses, were deemed finally to be unrealistic, mining actually increased by 21% in terms of the overall index in the context of a market environment which fell by 49%. Now that is the benefit of value investing. If you consistently invest in stocks which are undervalued, your outcome from that point, even though it may not feel like that in getting to there, is going to be better than if you follow the momentum to the top of the market. Even if, up until the point that the market capitulates, that feels very safe and comfortable. It is not. The RECM Global Flexible Fund sits with a portfolio of assets which has a discount to fair value of around 35%. What that means is that if we're 100% correct, the upside is more than 50%. Of course, we don't think that we will be 100% correct. No one ever is. But even if we're halfway correct, that proposition in the context of a market environment that is looking very risky, and which, as I say, has significant downside risk attached to it, we feel is very compelling indeed. Thank you for your time today.